Hi, this is Paul, and this is the tutorial for the manager indicator suite. So this indicator suite is designed to maximize your profits and give you a set of rules and indicators to take aggressive or conservative profits on your trades. So why did we do this? So every trader can get in a long or a short trade with literally hundreds of different trading indicators, really, lots of different strategies. But most of the time, they always struggle with trade management and to maximize profits consistently. So consistently means having those same rules to abide by when managing those trades. So the manager combines price action, different volume behaviors and special EMA bias clouds, each with 4 different settings to allow for day trading and swing trading strategies. Our algorithm works behind the scenes to display the information in your chart to allow you to quickly, sensibly and repeatably make those decisions for managing your trades. It's about repeating the same strategy all the time to maximize those profits, not second guessing. So a few simple things to remember when you're using the manager. Have the manager running on your charts at all times, because you don't know when you're going to get in a trade, especially if you're scalping or day trading. And so ensure you have the selected, you selected that correct settings for the management of your trade, and those settings we'll go through in a little while. And follow the rules discussed in this presentation and tutorial to optimize your profits of your long and short trades. So follow the rules. So this is these are the settings that we have there. Now this is the TradingView version. The same settings, it looks slightly different in each one, whether it's motive, wave, think or swim, trade station, MT4, Ninja Trader. Looks slightly different, but the same settings are still there. So default settings are day trading moderate. So that would be your default setting if you're day trading. So we've got a lot of day traders using our software, so we put that as default. Then we have a day trading aggressive, and if you're scalping off the 1, the 2 or the 3 minute, you may want to start off with day trading aggressive settings on this the manager. So that's something you would consider, or something we'll discuss later is actually changing to aggressive when we get certain moves when we're in a trade. We've got day trading conservative, so maybe you're day trading on the 15 minute, or you want to be a little bit more conservative and allowing it to run for the whole session, and that conservative could be a good setting for that. And then obviously the swing trading setting as well. We also use a day trading conservative for a more aggressive type of swing trading setting. So there's some styling that you can do. You can change the volume candle colors, but the way we teach this is we need the green, the red, the gray, the cyan, so to help you identify that volume behavior. The average, above average volume at the moment is set to circle and cyan, but you can change the shape of the color, and you can change the color as well. And then obviously below average volume at the moment is set to blue circle, and that goes below the candle. I would suggest you don't change where it actually goes, but if you want to change the color and the shape, you can do that. The fast MA and the slow MA, that's just the bottom of our bias cloud. I suggest you can change those if you wish, but the main important thing is the MA ribbon. Do not change those green and reds. They are set to identify when it changes from green to red bias there on that EMA cloud. So first thing we're going to look at is average volume. We're going to go through this quite briefly, then we're going to look at accumulation distribution, then we're going to see what it looks like on the chart. So with average volume, by knowing the total volume on a candle, you can understand the power or influence on a given instrument. The greater volume, the greater influence for the price to change. So if we can compare each candle's volume over a given period and work out the average volume, then this helps us identify the momentum when a candle has volume above that average, or indeed falling momentum when the candle has less than average volume as well. So there's no need to use these fancy formulas and tools. The manager does it all for you and identifies on the chart if each candle has higher than average volume or lower than average volume, or is in fact neutral, the same. It also determines the correct look back period to work out on. So you don't need to look at this very formula. You don't need to draw lines of best fit. Forget all of that. The visual that you get from these dots up above and below, and it doing it automatically, gives you an instant an instant look at that behavior. So some basics first, understanding the volume. We're going to look at volume accumulation candles and volume distribution candles. So as well as those average indications that we get, those average volumes, whether it's above or below, we need to understand the actual volume of that particular candle as well, compared to the previous candle, because that's quite important. So an accumulation candle is when people amass or accumulate more of an instrument, whether it's crypto or futures, at the ask, so putting in buy orders, than at the bid, so putting in sell orders in a single sort of candle time frame, whether it's a day, whether it's 5 minute or 2 minute or 15 minute. So if an instrument has 2 or more accumulation candles, we can say that it looks pretty strong or bullish. Remember, for the second accumulation candle, the volume of that candle has to be higher than the previous accumulation candle's volume as well. So if we look on here, we can see this is just a volume chart. So this first volume is here where my cursor is, and then the next candle has higher volume, so that's classed as an accumulation candle. The next volume is pretty flat. The next candle has higher than the previous candle, so that is accumulation candle. So that momentum's still building to the upside. And then further, the next candle has even higher volume, so that's another accumulation candle. That momentum's really going now. And then we get another accumulation candle, so that momentum's even going even further. So we're building that momentum. There's more traders putting in buy orders on each of those candles and giving more volume. So what does it look like on the chart for the manager? We've got average volume and bullish candles on the manager chart, so we're going to go through what those mean. So first of all, remember, we colour these candles. So a green candle is an accumulation candle. So it has higher volume than the previous candle. In this case, we can see some really good contraction on price action, but the volume is increasing. There's more buy orders on each candle. So whether that's in a 5 minute or a daily candle, there's more buy orders coming in. So the momentum is bullish. Then we can see here we've got higher than average volume, this cyan dot here. So not only as each candle starting to increase in volume, the more buy orders going in, that's higher than average volume as well. So that's really good momentum going here. Then we get some grey candles. So these really don't have higher highs. They're up candles, but they have less volume than the previous candle. But look, they're still higher than average volume, so that momentum is still bullish. Then all of a sudden we peak out, so we get another green accumulation candle with higher than average volume, with that cyan dot up above. Then we get a grey candle. Then all of a sudden we get some indecision here on 3 candles. They're all up candles. One of them is an accumulation candle, but they're all lower than average volume. This is a sign that you should be looking to tighten your stops, or if you get, and we'll go through a scenario where you get a down candle with higher than average volume, that's the time to get out. So it's a warning sign, if you like, that this current bullish move is running out of juice. Now, if that continues to go sideways and pulls back and is lower than average volume, then it's probably going to run out of juice, and it's what we call a low volume pullback against the trend, and it's a sign to stay in. So again, it's not necessarily a signal to say get out. It's just a sign to say, hey, guess what? That bullish volume has run out. We may be pulling back or going flat, but it's not it's not higher than average volume. The volume's dropping off, so it should resume that bullish trend. But be careful, and we'll go about through the rules and what we can learn from these to help you manage it as we go along. So let's just look at volume distribution first, because we'll go down as well. So since we are giving out or dispersing, we're really selling our instruments. So we're selling gold, we're selling oil, we're selling Ethereum, or whatever it is. So the first major point to note about distribution candles is that it's related to the selling of an instrument, not buying, which is an accumulation. We've just done that. So this is the most important piece of the puzzle when looking at distribution candles. For a candle to be considered a distribution candle, the candles not only have to end down overall, from the open of the candle, but there also has to be more volume traded than the candles before. So it has more people selling. Okay, so if an instrument has 2 or more distribution candles, then we can say it looks pretty weak, bearish. Remember, again, for that second distribution candle, the candle volume has to be higher than the previous distribution candle's volume to get that momentum to go down. So for a distribution candle to be considered heavy, the volume not only needs to be greater than the candle prior, but also greater than the average candle volume as well. And we'll go look at a chart on that. So volume increases are more acute compared to longs when we're going down. Things go down faster than gravity is present in all markets, and you will notice that. So we can see here, this candle here has much more volume. That's a distribution candle, and again the next candle is a distribution candle again. But then we get a lower candle. Okay, that's fine. And we'll talk about that color in a little minute, but then the momentum picks up again. Distribution. Okay, so now what that looks like on the chart: average volume and bearish candles on the manager chart. So this is a bearish move. We've got higher than average volume, okay, with the cyan candles up above, which is a good sign. We've got those red distribution candles, so that that volume is really picking up here and coming down. Now then we get those candles where the volume compared to the previous candle is less, so that's colored in cyan, but we still have that higher than average volume, so that momentum is still pushing down. And then we start to get some consolidation, some support, but they're all low volume candles, lower than average volume at the moment. So at the moment we're still considering that this is a low volume pullback against that main trend. So to be aware but not to panic is the criteria there. Even though on the right here we can see we have an accumulation candle, a green candle, so higher volume than the previous candle, and it is a bullish candle, but it's still lower than average volume, so there's no reason to panic and start to get out just yet. So we see that low volume dot there, that blue dot below the candles there. So price action is very important. Combining price action knowledge with the volume aspects we just discussed is a key skill, and taught in a separate video. The link will be in the description of this video, so you can go and see how that volume, you can combine that volume with price action and certain candlestick patterns to help you understand those potential reversals. So the bias EMA cloud. This cloud is adjustable with 4 different parameters, and we went through that earlier on in this tutorial. So green on the bias EMA cloud is for bullish bias to the current move, and red is for bearish bias to the current move. But when the green changes to red, this is your conservative exit for a long trade. Okay, when the red changes to green, this is your conservative exit for a short trade. So the cloud is advanced ahead of current candle to help give you plenty of warning. Plus also we have those different settings to give you aggressive, moderate, conservative or swing trading settings as well. And we're going to go through examples of that in a second. Okay, so Let's look at day trading on the moderate setting. So this is the default setting. So this is euro, US dollar on the 5 minute. Again, I can use that on the TradingView version and other versions because that particular broker FXCM provides volume for that. If your broker doesn't provide volume, then you're not going to be able to use the manager. Volume is a very critical part of managing trades and understanding behavior. So we have the red bias cloud popping along there. You can see this current price action. We did come down and then it's going sideways and trying to pull back. Majority of it is lower than average volume. The higher than average volume that we get are down. Is a big distribution candle. We can see the cloud thin on this pullback here. But majority of these candles here are red distribution candles with higher than average volume. That's shown as the momentum is still to the downside. And again, if we're just using the bias EMA cloud on the moderate setting, it doesn't change green. So we stay in the trade and then look what happens. We then go from, moving down slowly to a big parabolic move. And we can see here, we just exploded view there that the bias turns to green at that point, and that would be our exit at 1.17633. So that's using that moderate day trading setting. Now this is the aggressive setting. One thing to note here, we've still got the cloud red during this move, but it's not a parabolic move, it's a slow move down, and you can see here the cloud just momentarily turns to green. So if you're following the rules, you would get out of this trade on this point, and we're going to look at lessons learned by this in a couple of slides. Again, something working against that green is all these higher than average volume distribution candles. However, we can see when we've gone aggressive because of this parabolic move, that changes the pointing where the cloud turns from red to green. So now our take profit is a lot lower. So we're making more money on this short. So 1.17604 compared to that much higher take profit on the moderate setting. Okay, so just bear that in mind and then we'll talk about those rules. So when the volume rules trump the bias cloud rules, okay, so aggressive profit taking. So remember the EMA bias cloud is for sort of conservative exit. Aggressive profit taking for potentially violent reversals, and that's when the volume rules trump those bias cloud rules. So this is another example here. We've got day trading moderate setting on here. We can see we've got a really big parabolic move here with a red cloud coming up. We can see the cloud is still red at this point, but we get a big accumulation candle here with higher than average volume. So this is a big candle. It's closing near the highs. It's got higher volume than the previous candle, which did have higher volume than the previous candle before that, but it was a down candle. But it was almost engulfing. We've got higher than average volume. That's the time to get out. If you'd waited for the cloud to change, you would have not made as much profit because you at this point you consider that this could be a violent move back up against that main trend. And then on the other side, we're in this long trade now. You've got the bias cloud is green at this point, but we get a high volume distribution candle closing near the low here. Not only that, it happens a second time. This is a warning sign to get out now rather than wait for the cloud to change to red. So this is where those sort of potentially violent reversals against those moves, that trade that you're in, happens, the cloud will always take a little bit more time to react, and that's why we use it as a conservative trade management tool. Whereas if we're potentially getting these big violent moves, those violent moves are going to have accumulation or distribution candles, and they're going to have higher than average volume. And a catalyst for this will be some data that affected light crude. Now, you may not understand that data, you may have missed that data, but the manager tells you something's happening. It is changing direction, potentially, accumulation or distribution and higher than average volume. So that's day trading moderate. So now if we do day trading aggressive, for example, again, look at this. I'm going to mention this again, parabolic move, okay? And then we're going to go through the rules. So this parabolic move, you can see now though, the cloud changes to green here, and we would actually get a better profit than waiting for that candle here. So one thing we must note is when we're in a trade and we get a parabolic move, we must adjust that setting to day trading aggressive so we can get out of the trade and maximize those profits a lot earlier with that cloud change. So again, understanding that's a parabolic move, changing the setting to aggressive would actually have made you more money than this warning sign for this violent reversal just here. Same again on here, we get the move up, we get the move down here, that candle closes down at this point where my cursor is here, that's a sign there's a violent reversal. It does come back up again, but look where the cloud, you get another warning there, and then the cloud changes at this point here. So you can see by changing that to aggressive day trading, you do maximize those profits even more. But you've got to understand the move. If it's a flat move and you go aggressive, it could take you out too early. This is why we got these different settings. So what can we learn from this? Again, pause, go back, watch those explanations. So when day trading, your position has a parabolic move, and go back, look at those charts, look what I say is a parabolic move, change the settings to day trading aggressive. Okay, so when you're short trading and you get an accumulation green candle with higher than average volume, aggressive profit taking is necessary. So if you've forgotten to change your cloud settings to aggressive, or the cloud is still, and you've done that and the cloud is still in the direction of where you're going, but and you're going short, you get that accumulation green candle with a higher than average volume with that cyan dot above, you need to be taking profit pretty damn quick, because it is, there's potential for that violent reversal. So when you're long trading, is the opposite way round. You get that red distribution candle with higher than average volume, that cyan data above, aggressive profit taking is necessary again. The good thing about this being on YouTube, guys, you can pause, you can go back, you can go through those explanations again. So what about when you're swing trading? So you're always going to start off on the swing trading setting, okay, as we have that longer term view when we're swing trading, and you're looking for the instrument to build momentum over a longer period. So typically you would use 4-hour daily and weekly time frames when you are swing trading, rather than the 2, 3, 5, 15 minute for day trading. So we're going to talk through some examples for this as well. So this is an XBRAT signal. XBRAT algo is it's my proprietary indicator to give you those signals for those longs, and we can then note that we get some of those accumulation candles and higher than average volume. This is really, really good. So we're already in this trade, we're getting that, because we're in that swing trading setting, the actual cloud is still red, but we've got the signal. We need to manage that signal now. We're in the trade, we've got some good bullish momentum with accumulation candles and higher than average volume. Then we have a pullback, but the majority of these candles, remember, each one is a day. There's no stress when swing trading. But sorry about that. majority of these candles are lower than average volume. This is a low volume pullback. And remember, the cloud is green here. Okay, the cloud is green. We do get some one candle wonders with higher than average volume and those distribution. But remember, when we're swing trading, we're giving time to build momentum. The cloud is still green. We're going to let it run. Then we get parabolic move, almost straight up here. We get accumulation candles, higher than average volume candles. This thing goes. Look how the cloud then starts to move apart. Then we get a pullback, low volume pullback, lower than average dots, lower than average volume dots on the bottom. Okay, so this is standard profit taking, if you like. It's lower than average volume, so we're not too concerned. The cloud is getting wider. We still keep getting these, these little pullbacks. It's lower than average volume. We get a little boost with higher than average volume and accumulation candles, until finally we're really up here on this wave 3, on the Elliott wave here. And there's some options here. At this point here, we get higher than average volume distribution candle. Okay, it's engulfing that little indecision doji at the wave 3. For those that look at Elliott wave, if we go back during this wave 3 period, that happens once before here. Okay, it happens here. So it's not a sign to aggressively get out straight away, but they're not followed through. Now we're getting lower lows, lower highs, and it happens again twice. Tighten your stops or get out with that aggressive exit, but the cloud is still green, guys, and we're coming back on a wave 4. For those that, like me, you're not panicking. The cloud holds. It's green, we're still bullish. We then start to move away from that wave 4 low with accumulation candles. And then finally, although the cloud is getting thinner, it's still green, we start to get accumulation candles with higher than average volume. So it's moving back again. So 2 trains of thought when you swing trading. You've got in all the way down here at $26. You're starting to get some real big moves down with higher than average volume, distribution candles. Take your profit around $44. Okay. Then if it finds support and starts to move back on a 5th wave move, buy in again, and then manage it with the cloud and the volume, the average volume, or the volume distribution, or the combination that we've talked about. So really, this really helps you manage those swing trades sensibly. Some people would like to get out near the highs, take the profit, wait for the wave 4 pullback, and then get back in and buy some more. That's fine. For me, if you're investing when you're using those swing trading strategies, and that is, so it's a standard profit taking pullback, if you like, on that wave 4, as long as that cloud remains green and you find good support in those probability pullback zones, let it ride, let it come back up again, because it's behaving normally, and those candles allow you, and that bias cloud allows you to understand that. So this is a different type of setting here, and what I want to do is go through where we change those settings when we have some parabolic moves and some reactions to earnings or other data. So again, we've got a 4, 5 and 6 star expired algo down on the left here, really strong buy signals here, and we'd want to be getting in this trade here. So we're in just about $25 or something like that, just where my cursor is here. We get low volume pullbacks here. The cloud is still green. This candle here is actually an accumulation candle, a bullish candle with higher than average volume. It rejects the lows and then starts to move up again. The cloud is still green. The cloud gets further and further apart. It's still green, but then we get our first parabolic move up here. We get low volume pullback because we're lower than average volume here. Then we get another parabolic move leading into earnings. This is the earnings here. This is the reaction. So let's have a zoomed in look at that reaction. Now, a couple of things to point out. we had the gap up on earnings, we tried to move higher, and then it rejected those highs and actually closed lower than the open. So this is a high volume rejection. So not only is it a distribution candle that we talked about because it's colored in red, it's higher than average volume. This is a high volume rejection, not just with distribution, but with average volume as well. This is an indication that this is the start of quite a severe pullback, because that earnings reaction didn't want to push up. More people wanted to sell in the end. Look at those for the next day, and then we start to come down and we pull back into there. So recognizing that and using the manager to recognize that behavior is very, very important, and we'll go through that what we've learned section in a little while. And you can see here though it does come down, but using that swing trading setting we would get out around about $52 instead of the following day, if it breaks the low of this rejection doji here, getting out around about $68. So there's a massive difference in that profit there. So that behavior, that gives you that warning sign that, hey, high volume rejection here on earnings, this is potentially a violent pullback. So that's on the swing trading setting. So recognizing that that behavior on earnings that we just discussed, that high volume rejection here, you could change your setting to day trading conservative. Okay, this would close the cloud around about $58. Okay, so giving it room to move, eventually the cloud changes at $58. So that's a lot better than down here where it changed before around about $52. So that's better. If you didn't go aggressive that we've discussed before with that higher than average volume, the distribution cloud indicating, hey, this is an aggressive exit to take max profits, and you want to let it run just in case there's a bit of a rebound, go to day trading conservative. Or what about going to day trading moderate setting? In this case, your profit would have been taken out around $62 here. So you've got those settings, but recognizing, and again, each one of these candles is a day, so you don't need to be in front of the computer 24 hours a day to recognize this when swing trading. You recognize that. I'm going to say it again, high volume rejection, higher than average volume, distribution candle, after the earnings, it's a sign it's coming down violently. Go to day trading moderate settings if you didn't take the aggressive exit, and that would give you around about a $64 exit or something like that. So a better exit than the actual conservative. So you've got those settings. It's recognizing what's happened and then adjusting as and when. So what can we learn from this? So when swing trading, we must always look at volume reactions to earnings and other data flashpoints. So, when they have we have then options to adjust settings down to day trading settings, or use that aggressive profit taking exit strategy when we are long and a red distribution candle occurs with higher than average volume, that cyan dot above, get out aggressively. Or when we are short, we get that green accumulation candle that occurs with a higher than average volume, that cyan dot above again. We want to go back again, pause, go back through that those explanations. But also remember, we can actually use that when we're day trading as well, because there's lots of data points during the day, especially before or just after the US market opens. There's big data points that can actually move things. And if you're already in a trade, or even during the European morning, if you're in a trade and you get those high volume rejections and you get this same setting, even if it's on a 5-minute time frame, recognize that, adjust accordingly aggressive, or use that aggressive exit strategy to get your profits taken out. So remember, when day trading or swing trading, there is usually a data or news catalyst that that reverses the move. The manager soon spots those with either accumulation or distribution candles combining with that higher than average volume, and usually a distinct candlestick formation rejecting those highs and lows. This is one of the most important things here. There's a reason why things reverse. So if you're in a long, there's a reason why it starts to go short, and usually that catalyst produces higher than average volume and an accumulation or distribution candle, and the manager spots that and prints it on your chart so you can understand that you need to be either aggressive with that exit straight away, or in fact change those settings. So don't second guess when you're managing trades. Follow the same rules. If you have the manager on your chart, you follow the manager's directions. That's why it's called the manager. He's there to help maximize profits. Hopefully this helps. Good explanations. Pause, go back. Simple rules. Follow those simple rules, combining that average volume, distribution or accumulation, and those cloud settings, and you will start to see more consistent profits, more maximizing those profits.